For the program, those comments from St. Louis Fed President James Bullard, who suggested that only one rate hike would be necessary over the next 2.5 years. It was a stunning reversal from Mr. Bullard, only adding to questions of whether the Fed has lost its credibility. Our next guest has suggested as much. Jeffrey Gundlach is the CEO of Double Line Capital, joins us exclusively now by phone. Jeffrey, welcome back. It's good to talk to you today.
Hey, Judge, it's good to be here. It's been 6 months to the day since we've been together.
Yeah, well, welcome back. Let's talk Bullard first. Only one rate hike over the next 2.5 years, says the long-run outlook of the U.S. economy is, in his words, uncertain. What's your reaction to what he said today?
Well, I'm not so sure about 2.5-year predictions when we've been watching the Fed change their opinion every other week. But I think he's coming around to reality, as is the Fed, broadly speaking. One thing I've been talking about for quite a while now is just how stable GDP has been on both a real and nominal basis. I mean, for years we had predictions that real GDP would come in above 3% as a hope, maybe 18 months forward, and it always comes in at 2% plus or minus something. And so now we see that the Fed has kind of given up on this idea that somehow we're going to ratchet up to a 3% real growth pattern. You see it from the SEP report that came out on Wednesday, that they basically just say GDP is going to be 2 this year, 2 next year, 2 the next year, 2 in the long run. And that's not so much as a forecast as it is a recognition of reality. I mean, that's where it's been for like 6-7 years. And so I think the Fed, you mentioned losing credibility. I actually think they gained a little bit of credibility, although confused, this week by at least acknowledging reality.
Sure, but do you think that the Fed has a good handle on where this economy is today and where it's heading?
I don't think central bankers around the world fully understand what the consequences of their policies. One of the charts that used to be popular, and I think it's still worth looking at, is the chart of the S&P 500 overlaid on the size of the Fed's balance sheet. It's really uncanny how the S&P 500 rallied when they were doing QE and expanding their balance sheet, and how the S&P never goes anywhere when they're not expanding their balance sheet. Of course, they stopped expanding their balance sheet. They stopped QE3 back in December of 14, and the S&P 500, the Dow Jones Industrial Average, the NASDAQ are all exactly the same as they were when they stopped expanding their balance sheet. But so the Fed not expanding their balance sheet seems to make what I've been talking about, the S&P 500, as dead money. And it's been dead money with no price change for 18 months. But what's going on overseas is what's really out of control, and that is where they don't understand that negative interest rate policies do not inflate their stock markets. Negative interest rate policies do not improve growth. Negative interest rate policies do not weaken currencies. If you just look at what's happened in Europe since they went negative, their stock market, the DAX, is down 20%. The euro is up in the high single digits. If you look over to Japan, since they went negative in January of this year, the Nikkei is down 10%. The yen is up 10%. You see, negative interest rates do not cause the outcomes that central bankers think they do, but they don't understand it yet.
Is that why you have said, and I quote, central banks are losing control?
Exactly. When they did QE, they were having the outcome, at least here in the United States, but I would say broadly, that they were, I guess, looking for, which was to stimulate asset prices, and the stock market did go up. They're out of control now because the policies that they're implementing don't have the consequences that they're looking for. They have the opposite consequences. And the reason is that by going to negative interest rates, you do not stimulate consumption. You actually stimulate savings. If you look at countries in Europe and you look at their deposit rates as they've declined, their saving rates have been going up systematically as the rates have gone negative systematically, and that's actually understandable. Think about somebody who's watching this program, Judge, who's 60 years old and thinking maybe they want to retire in 10 years at age 70, and maybe by old school thinking, they think, hey, I need to save $1 million, and if I get old school interest rates of like 5%, I'll get $50,000 a year off of that, together with Social Security, I'll be okay. But now, if you start to get confidence, like sort of Bullard now is forecasting, that interest rates may stay at rock bottom levels near zero for that time period, you don't need to save $1 million. You need to save $2 million. If you think that you were going to live another 20 years or so, from age 70 to 90, your life expectancy, you were going to get $50,000 a year for 20 years. That's $1 million. You're getting zero now. So you don't need to save $1 million to be in the same position when you're 90. You need to save $2 million. So no surprise that when you go to negative interest rates, you do not stimulate consumption, you necessitate savings. You cannot fight deflation with deflation. Negative interest rates are the definition of deflation. If you have a 40 basis point negative yield on a 5-year note, you invest $100 today, you get $98 5 years from now. That's the definition of deflation. You cannot put out a fire by pouring gasoline on it.
Let me ask you this. I'm sorry, finish your thought. Go ahead, finish
well,
your thought.
All I'm going to say is I think the next thing that's going to happen is central bankers are going to come to the conclusion that negative interest rates are still a great thing, they just haven't done enough of it. And we're going to get one more round, I think, of even further negative interest rates. And of course, the same thing is going to happen. The same thing is going to happen. You're going to get stronger currencies, weaker markets in those places where they're doing that. And then finally, I think they'll say, this doesn't seem to be working. Maybe we need fiscal stimulus. And when that comes, then that's when the game will change.
Let me ask you this. How many times do you think the Fed will raise rates this year, and how many times do you think they should?
Well, as you know, Judge, back in December, I said they're going to raise rates today, but it's a mistake. And, of course, the global markets crashed when they raised rates in December. I don't think they should raise rates at all. And, frankly, I don't think the data is encouraging them to raise rates. Obviously, they did a massive psychological shift on Wednesday. I don't think they're going to raise rates at all this year.
Wow. Jeffrey, stand by for me. We're going to take a quick break. On the other side, come back, talk to you on some more market reaction, Brexit, a whole lot more. More with Jeffrey Gundlach of Double Line Capital after this quick break.